Well, hello everyone and welcome to Momentum channel. In this video, we're going to be taking a look at two undervalued consumer staples, the dividend stocks that you could consider to buy or watch right now in the stock market. The first company to review is called Walgreens Boots Alliance. It is traded on NASDAQ with ticker symbol WBA. Walgreens has its roots going back to 1901 when Charles Walgreen bought the Chicago drugstore where he had worked as a pharmacist, making the beginning of the Walgreens chain. And the company then went on to open thousands of new stores throughout America and took its business worldwide in 2014 after merging with Alliance Boots, Europe's biggest pharmacy chain and a leading international beauty group. You notice here that the stock has a dividend safety score of 79, considered to be safe dividend payer. They do pay a dividend currently yielding 3.80%. The stock's last trading price at the time of making this video was $50.29, and the company and its stock is considered to be a large cap company with $43.9 billion in market capitalization. When it comes to stock price volatility, the stock has a beta ratio of 0.63, which is considered to be low volatility compared to general or stock market stock price volatility. Walgreens generates most of its profits from their retail sales of pharmaceuticals and general merchandise in the US, with smaller contributions from its international retail pharmacy operations and wholesale drug business. Looking at the key metrics from a dividend perspective, the company's dividend payout ratio is currently 38%, with is a little bit edging higher for consumer retailers as a whole, but overall, this payout ratio is under 60%, and from our perspective, is considered to be a very decent dividend payout ratio, leaving a lot of room for growing their dividend amount over the years to come. What's more, from a dividend streak perspective, the company has paid its dividend uninterrupted for 45 years. During the recession of 2007 to 2009, the company actually continued to even increase their dividend payments, which is remarkable. What's more, during that recession years between 2007 and 2009, the company's sales actually grew by 5.6%, which shows to be above average as a whole for those timelines. And when it comes to the stock price return during those recession years, the stock plummeted by an average of 44%, but it was better than overall S&P 500's return of negative 55% during the 2007 to 2009 recession timeframe. Looking at the annual dividends amount per share and how it's evolved over the years, the chart shows you the past 20 years and how the company has increased it. It's noticeable that the company has increased its dividend as well consecutively for the past 45 years. The company does pay its dividend on a quarterly basis in the months of March, June, September, and December, and currently does pay an annual payout amount of $1.91. Looking at the valuation of the company, Walgreens Boots current dividend yield of 3.80% is 35% above their own 5-year average of 2.80%, indicating that now could be a reasonable time to invest unless you believe that the company's outlook has weakened. This sudden increase in actually dividend yield could occur when the stock price has gone down quickly, and as a result of that, the dividend amount has artificially has actually increased, suggesting that there's room for the company actually to grow in terms of its price, or for the company as well to adjust its dividend amounts. In addition, WBA's forward price to earnings ratio of 10.4, as you'd see, is about in line with their own 5-year average of 10.5. But it is kind of a lot less than that of consumer staples. The market appears as a result to be valuing the stock similarly to how it has had in the past, judging by the 10.5 5-year average for the forward price to earnings ratio. When it comes to price range for the stock, the last trading price of $50.29 is hovering a little bit closer to the 52-week high price. The stock's 52-week high price was at $56.80, and their lowest price in the past 1 year has been at $33.52. Looking ahead at the company's total sales, their last 12 months overall sales for the company has been at $146 billion, which is the highest amount over the past 10 years. you'd see here since 2015, the company has actually drastically increased its total sales. It's upwards of $100 billion and has maintained that, and gradually over the past several years has increased it year after year. From an outstanding number of shares perspective, we would like the company to see their outstanding number of shares decline, and that gives you a bigger pie. In this case, you notice the last 12 months, they have an outstanding number of 866 million shares, which is the lowest amount over the past 10 years. So that's positive for us. When it comes to the stock price overall trends, on the right chart at the bottom, you're seeing the past 1 year return. The 1 year return for the stock price has been positive 35% plus, which is quite decent and remarkable. The 5 year though, you'd see here the stock price still compared to where it was 5 years ago, the stock price is down about 39%. While this is not ideal, but if you are thinking about Walgreens stock and investing in it from a dividend perspective, and knowing that the stock is considered to be undervalued at this time, it could be a suitable time for investors to consider adding or buying into shares of WBA. We are going to be taking a look at analyst estimates. There are 10 analysts on TipRanks hovering and covering the stock. 9 of them actually have a hold rating for the stock and 1 with a buy rating. The highest price target, according to analysts on TipRanks, is at $68 and the lowest being at $48, which is a little bit less than what the stock price currently is trading at, with an average price target of $54.11. If that holds true, that shows an upside of 7.6%. However, the story is different when it comes to Simply Wall Street. According to their analysts and the fair valuation for the stock price, they are having a fair valuation of $123 for the stock. And if that stays true, that shows that Walgreens stock is actually undervalued by about close to 59%. All right, before we get into the rest of the video and take a look at their second undervalued consumer staples stock to review, I have a big favor to ask you. Here on Momentum Finance Log Investing channel, we post every week several videos talking about investing in the stock market and investing in other avenues such as real estate and crypto, as well as talking about ways to reach financial freedom. We appreciate if you can give this video a thumbs up and subscribe to our channel for more related videos. Thank you. All right, with that, let's take a look at the second undervalued consumer staples stock that we have for you. And this company is a very safe dividend payer with a score of 99, considered to be very, very safe. It is a mid-cap company with a market capitalization of $5.89 billion. And it is, again, considered to be a low volatile stock with a volatility score of 0.63. A volatility score of under 1 suggests that the stock is less volatile than the overall stock market. This company is called Ingredion, and it is traded on New York Stock Exchange with ticker symbol INGR. Ingredion produces and sells starches and sweeteners for various industries, and it serves food, beverage, paper, and corrugating products, brewing, pharmaceutical, textile, and personal care industries, as well as animal feed markets. The company was formerly known as Corn Products International and changed its name to Ingredion in June of 2012. Ingredion was founded in 1906 and is headquartered in Westchester, Illinois. The company actually currently pays a dividend yielding 2.91%, and the last trading price for it was $88.12. Moving on, looking at the dividend key metrics, this is also a low payout ratio shown here, which is considered to be low for consumer staples, leaving the company a ton of room to grow their dividend in the years to come, with their payout ratio of only 35%. The company has been paying its dividend uninterrupted for the past 22 years. And when it comes to their dividend payments during the recession between 2007 and 2009, they maintained their dividend. They didn't cut their dividend nor lowered it or stopped it, but rather maintained their amount of dividend. When it comes to their sales during the recession, their sales was down by 8.2%, which is average growth during those years for the company and its field. When it comes to their recession return during the recession, though, their stock actually went down by 62%, which is worse than that of S&P 500. So they did not do as well during the recession when we compare that to Walgreens, the previous stock that we reviewed. something for you to be mindful of. When it comes to annual dividends per share, the company does pay a $2.56 annual dividend at this time per share. They pay their dividend quarterly on the months of January, April, July, and October, and they have increased their dividend year after year for the past 10 years. As we mentioned, they have paying their dividend uninterrupted without any reduction since 22 years ago. All right. When it comes to the valuation, the ingredients current dividend yield of 2.91% is 9% above their 5-year average of 2.66, indicating that now could be a reasonable time to invest unless you believe that the company's outlook has weakened. In addition, their forward price to earning ratio of 13.9 is in line with their own 5-year average of 13.8. The market appears as a result to be valuing the stock similarly to how it has in the past, suggesting that the stock could be fairly priced if you believe in its health and long-term prospects being solid. Looking at the price range, the highest price for the stock in the past 1 year has been $97.59 and lowest has been $69.25. We're going to take a look at the number of outstanding shares for the company too. The last 12 months, they are showing $67.4 million outstanding shares, which is again at par or lowest amount of outstanding shares for the company. Ideally, we'd like personally for a dividend paying company to see the one that they are decreasing their amount of outstanding shares by buying back their shares, which seems to be the case for at least for the ingredient over the span of the past 10 years. When it comes to their total sales, their last 12 months, they are showing $6.47 billion in total sales, which is almost the highest amount that they have had in the past 10 years, with the only exception being in 2012, whereby they had $6.53 billion in share in terms of their total sales for the company. Over the past 1 year, the stock has returned a modest 8.68%, not the greatest appreciation. Nonetheless, it's positive. However, in the past 5 years, the stock is showing to be down by 36.7%. Again, investing in ingredient, probably you're counting more so on its dividend and not so much necessarily on their stock appreciation. Nonetheless, the only exception to that is if the stock is actually still continue to be undervalued, providing you some room still to grow for the stock. When it comes to analyst estimates, TipRanks does not have coverage for this stock. So we've looked at Yahoo Finance and Simply Wall Street. From Yahoo Finance analyst estimate, the 1-year price target for the stock is at $94.20, showing some upside for the stock. And when it comes to Simply Wall Street, though, appears a much more bullish approach. From a Simply Wall Street approach, this company is considered to be undervalued by about 53%, with a fair valuation of $188.05, according to analysts on Simply Wall Street. Well, there you have it, folks. A quick look and review into the 2 undervalued consumer staples stocks that you could consider to watch right now in the stock market, or do your research, and then afterwards, if you decide so, you might consider to add that to your portfolio. Let us know if you are invested in any of these 2 companies at this time. We'd love to hear from you, so be sure to leave us a comment down below and let us know what dividend stocks you are looking at or adding to your portfolio at this time in the stock market. I hope you found this video beneficial and gained something of value from it. If you did, please don't forget to give this video a thumbs up. And of course, be sure to subscribe to Momentum channel. Here on Momentum Finance, we post every week several videos about investing in the stock market and financial freedom. Thank you, and we hope to see you next time.